transparency, right? So these events, we want you to be able to not think about this at all until you come to an event or you get a book or you get an update. We'll give you the update, you go home, you sleep easy. You don't have anything to be concerned about. You don't have to be involved if you don't want to. If you don't want to come to the events, you don't have to, but we very much appreciate when you do. And we want to make sure that you guys have transparency to the information, right? So our booklets, the budgets that we present, you have access to all the information. You have access to the information in your portal. If you have questions, you have access to all of us as well. So I just want to make sure, now that I've chatted a little bit, everyone can hear me okay? Audio's good online. You got the check mark. Everyone says that we're good. If there's any questions, this is not a formal presentation. We're going to go back and forth. You're going to hear from Andrew. You're going to hear from Scott. If you have questions, throw up a hand. Ask us a question. Last event in the big Galt, we had a little Cash for Clarity challenge. And you guys didn't challenge us all that much. But if we have acronyms, if we use something and you're like, I have no idea what the heck that means, and we don't explain it, if you raise your hand and make us explain it, we'll donate $100 to charity. So a little bit of an incentive to stick up your hand if we're saying something that makes no sense. But I think that we've done a pretty good job of making sure if we have an acronym that we then explain what that acronym is. Are we good, Raymond? Everyone can hear okay? Everyone's good? Awesome. Again, any questions, you let us know. So one of the things I thought I would do is start on a little bit of a personal note, because at the last AGM, you guys were all sort of prepped and ready for me to run out to an expecting wife and a baby that was coming in short order, and he did come. Some of you, maybe most of you, know that there were some challenges attached to that pregnancy and our little guy who joined us. And so instead of me repeating and missing details of that story a bunch of times, I thought I'd give you guys a quick update how everything went, and then we'll dive into our formal program. So Mr. Oslo Wild was born on April 19th, so just after our AGM, and he was fittingly born on CDH Awareness Day. Bit of an interesting coincidence. He's happy, he's healthy, mom's doing good. It's been a very interesting journey to now be a dad and a father, and it's one that I love, and it's quite exciting. It definitely has its changes and turns every day. And so CDH is congenital diaphragmatic hernia. So you guys, I kind of said, hey, I'm going to be taken off, and I'm not sure exactly when I'll be back. Because of the condition that he was diagnosed with prior to him coming, he needed to be born in Calgary. Oslo needed to be born in Calgary and needed some special medical attention. And we didn't really know what that would exactly look like, but they told us, he'd have a 75% chance of surviving birth, and then we would have a bit of a recovery journey after that, which is tough. That's not something that any parent wants to hear, and not one that someone wants to necessarily go through. But I'm appreciative to the team to help us, through that. And so he was born on the 19th. The story ends very positively. He went in for surgery on the 21st. He got discharged in 31 days. And we were just up in Calgary for October 3rd to do a bit of the health checkup at 6 months, which is when we expected to be coming back from Calgary. And we got the all clear. So as of right now, he's doing fantastic. As you can see, he smiles and giggles, and it seems like he'll talk maybe as much as his dad. To have him as part of the Summis family, and appreciate thoughts, notes, the concern and check-ins from all of you. Checking in while we were up there. So we actually moved up to Calgary in April, moved back in June, but we're here and we're settled. And I think what's probably most impressive is through that whole journey, the Summis team was here to step in. They covered for us, for Amanda, me, and Oslo, and made sure that our day-to-day operations, our tenants, any investor questions were handled without any concern. So for those of you who have commented or been concerned about me getting hit by the proverbial bus, I can let you know that they did a bang-up job, and I'm really proud of them and proud to have them as team members. And so for a lot of our updates today, I want them to give you those updates. And so I'll invite Andrew up to kind of talk through Cal's progress over the last 6 months. Scott will talk about some projects, and then I'll return to wrap up. So thank you all very much, and I'll turn it over to Mr. Andrew.
It's always easy to follow baby pictures with dull financial information. So I hope you all appreciate that and you got the heartwarming side of you out now. No, but as Kendall mentioned, we'll have a little bit of a different cadence. Usually our fall summary event, we have a lot of new faces here. We kind of get together and we outline, hey, these are the project, or these are the properties that we bought throughout the year. These are the opportunities that we saw. This year, you know, with the combination of high interest rates and the fact that we're very selective with the assets that we bring into Cal, we outlined at the AGM that we're likely not going to be adding many assets into Cal this year. And, you know, that ended up coming true. We instead at the AGM, we talked about how we're going to shift our capital plan focus from adding assets to redeveloping the assets that we own and creating value and rent growth in the assets that we actually have in the current portfolio. So what I want to do first here is just take a look at our portfolio. We'll just kind of go high level. All of the books that we have in the back there, all the books you have in front of you, that has some more detailed information. So we'll just kind of go through it high level here. So the first two numbers I want to highlight are on the left-hand side of the screen. The first is the GAV, or the gross asset value. This is essentially just the size of the fund. And the size of the fund is $3 million higher than what we presented to you guys at the AGM. We're sitting at $82 million. The only asset that we did acquire in Cal and that we brought in was Outpost at the very start of the year. So that number's played pretty consistent. Like I say, up $3 million. The net operating income, this is essentially the revenue that we make on properties throughout the year. It's sitting just north of $5 million, and that's completely consistent with what we showed you guys at our AGM. The reason why that hasn't changed is because if you look over on the right-hand side, you'll see our budgets. So these are our property budgets. These are our property operating budgets for each of the properties that we have in Cal. One of the things that we think is very important is that when we present the budget to everybody at the start of the year, that we report on that exact same budget and that you see consistency and accuracy in the budgets that we present. It's a way that we can kind of make sure that our cash flow is going to be where we expect it to be. So you'll see the Cal overall portfolio sitting at 99%. You'll see a lot of 99s and 100s on that chart there. A couple outliers I want to chat about quickly. The first one is the Decade Warehouse. So that's sitting at 73%. Decade, is our only major vacancy in the portfolio right now. We're planning on having a tenant in place. We ended up having a temporary tenant for a couple of months in the summer, which allowed us to recover some revenue there. But overall, we're a little below what we targeted and what we wanted for Decade. Same thing with the Hillman building. We have two vacancies there, or I should say we had two vacancies there. We are sitting at 87% to budget right now. Happy to say though that we expected, or we hope to have those vacancies filled earlier in the year. We weren't able to fill them earlier in the year, but as we're sitting right now, that building is fully occupied and no new expirations until 2026. So that building is going to be fully stabilized for the next few years. So long-term outlets at Hillman look very positive, but this year we're a little bit below budget. The other thing to quickly note is that these budgets, when we present them, usually at our fall summary, there is an element of reconciliation that happens at the end of the year. You know, expenses come in throughout the year, a little bit higher, a little bit lower. Those are billed back to the tenant. So most of these numbers are going to settle a lot closer to 100%, which is also what we see for Warehouse Square there. We're sitting at 125%. We're, you know, obviously a touch high. That's because our property tax bill came in a little bit lower than we thought. So, but most of these budgets are going to work much closer to 100 by the time the year's done. Questions? Perfect. Now, if anyone's going to ding me on acronyms, now's the time. This is going to be the one where you ding me on acronyms for sure. So this is our Cal Key Performance Indicators. You'll hear me call them KPIs. We presented these, this will be the third time that we've presented them to all of you. We present these are main metrics that the real estate industry uses. They're typically used for a property, but what we did is we distilled our entire portfolio as if it was a snapshot for a single property. You've probably heard Kendall or I talk a number of times that, hey, these KPIs show that Cal is very strong. A lot of strength in Cal. So what I want to do is just go through these KPIs really quickly. We'll go through the acronyms and feel free to ask questions if you want. but we'll look at what these mean and why they demonstrate strength. So the first one is cap rate. This stands for capitalization rate. It's probably the most recognizable KPI if you talk to people in real estate. Most people will mention cap rate. This is essentially the annual returns that you get on a property divided by the value of that property. So if you buy a property for $1 million and it brings in $100,000 a year, you have a 10% cap rate. The market uses cap rates to adjust for things like risk, location, and value of an asset. For example, if you buy, a worn down, run down building with some local tenants, maybe they're not doing so good, an investor might be interested in that asset, but he'd want that risk to be adjusted for. So he might want, a 12, 13 cap because he's going to want more investment or more return for his investment. Flip side, you go and you buy a very stable asset, you buy an asset that has some national tenants, really good covenants. That's going to be a lot stronger. Someone else might want to buy that as well, but they'd be willing to accept lower risk. So the cap rate would be, maybe 5 or 6%, a lot lower. Typically, cap rates vary based on the sector and the market, and even as interest rates rise and fall. So we're presenting right now 6.64. Typically in leverage, for those of you that kind of want to reference, you'd be looking at anywhere between 5.5 and an 8 cap would be kind of a standard cap rate that we have. Oh my goodness. Can you see if we can lower that?
There is no blind there.
Oh, perfect. Does anybody have any sunglasses? No, that's okay. I'm gonna be a big boy and tough it out.
It's a pretty sunset.
It is a beautiful sunset. All right, so I'm not done talking about cap rates yet, though. So cap rates also, there's variables in cap rates. Sometimes you might have an owner that is applying expenses to a cap rate that a seller might not, or that a buyer might not buy. So there's some variables. Not every cap rate is just set and the market completely agrees on it. There's also issues with vacancy. If you have vacancy on a property, you have future cash flow kind of associated with that property, but that future cash flow isn't realized, so it'll be discounted at different rates. Now, the reason I bring up both of those is because when we show a 6.64 cap rate on the fund, this is our actual in-place contracted revenue. We do have some vacancies in the portfolio. We don't factor in those. We don't discount that cash flow. We don't count that cash flow for future cash flow. This is our in-place revenue. So you hear us talk often about transparency, and this is one aspect where we can be totally clear and totally transparent. This is the revenue that we expect annually. Now, one of the other things that we'll talk about a little bit later is our target cap rate, because as Scott's going to come up, he's going to talk about the renovation projects that we're really excited about and how we're driving value in the fund, how we're driving rent growth in the fund. And so even though our cap rate is sitting at 6.64, we have a target cap rate that we want to realize within the next 12 months. And so we want to present that to you as well. Questions? No questions. So the next one up there is WALT. So this is your weighted average lease term. So this is essentially the weight of the lease, or the leases that we have in the portfolio weighted to the size of the lease. So if you have a very high value space, that high value space is going to be weighted more strongly to this metric. A lower value space is going to be weighted a little bit less. Now, we're sitting at just north of 6 years. Typically, publicly traded REITs, other real estate investment funds, you're going to be looking at anywhere between a 3 and a 4 year term is going to be pretty average to solid. So when we're looking at 6 years, again, it shows a lot of stability in our portfolio. Next, loan to value. So this is a measure of the debt that we have in the portfolio to our valuations. Kendall talked about it a little bit earlier when he talked about our mandate. Our mandate is between 50 and 65%. We're sitting at 53.21. Shows a very conservative cash position and a debt position. Some borrowers, they're going to be looking for, potentially higher leverage. Some funds would be targeting in their mandate, they might have between 65 and 80%. Obviously, higher leverage means more opportunity for investment, potentially higher returns, but also higher risk. Our fund is a conservative fund, so we target having that conservative LTV, and right now it's the lowest that we've ever had in the fund.
You're welcome, Art. Slash thank you, Art.
And so loan to value kind of ties into the next one, which is the bottom right of your screen, DSCR. So the DSCR is your debt service coverage ratio. This is your cash flow compared to your debt servicing obligations. So, excuse me. Banks, this is a really important one for banks. Banks are always looking at this number because they want to make sure that, hey, if interest rates move a little bit, you're still going to be able to fulfill your debt obligations. Right now, banks typically look for a 1.2 to 1.25 DSCR. They think that that's a strong indication that, hey, if rates move a little bit.
What is that?
DSCR.
ESCR?
DSCR, the bottom right hand of the screen there.
Sorry, you caught me not paying attention.
So yeah, 1.1, 1.2, 1.25, that's typically where banks want to see. They feel like that's a strong position for a fund to be in or for a property. So sitting at 1.76, obviously we have a large buffer there before we're in any kind of situation where we're not going to be able to cover our debt obligations. The next one on there is middle right hand there, the WAIR, the weighted average interest rate. So this is the average interest rate in our portfolio weighted to the size of the debt. So if you have a $7 million loan, the interest rate associated with that $7 million loan is going to count more towards this metric than like a $1 million loan. So, you know, this one's pretty self-explanatory when we look at where market is right now. You know, rates coming in over 6%. We're talking about a 4.39% weighted average interest rate. Obviously gives us a really strong, stable foundation as we continue to grow the fund. The next property that we buy, when we eventually do find something that we like, you know, we're going to be looking at, like, that number is going to increase over time. We're not going to be able to lock in debt, you know, sub 4.5.
How often does that change?
Whenever we buy a property. Yeah. So when we place new debt, then all of these numbers would update. So that's actually kind of what I was. Oh.
Sorry, I had another question. So you mentioned a range of 1.76 to 1 for the DSCR.
Yeah.
So why is that range like?
Why is there a ratio?
Why is that a range? Oh, that's your ratio actually. 1.76 is that.
Yeah, it's a ratio. So yeah, that's like, you know, 76%. We have 76% above what we need, what we absolutely need to cover our debt obligations. Where was it? Weighted average interest rate, 4.39. Oh yeah, what I was saying is that when we add properties to the portfolio, that's obviously going to tick up, but it really provides a really good foundation where we're sitting at right now. And then the last one on the list is the WAM. So this is our weighted average maturity. This is an important one with interest rates where they are right now. So this is essentially how long we have until the average term of our debt expires. So, you know, we all kind of know the current interest rate environment that we're in. A 3.28 WAM means that we have 3 years, a 3-year runway at the locked in debt, the fixed debt that we have in place before we're going to be looking at renewing any of that debt. As a further kind of point and a further note of security, we have no debt that's going to be expiring in 2023, and all of 2024, all of our debt is locked in. So when you see interest rates going up or whatever they're going to do in the next, you know, few weeks or few months, even the next year, we're not going to have to renew any of the debt in our portfolio for at least the first one is the Q2 of 2025. So we have a really long runway before we're going to be looking at renewing any of our debt. So that's our KPIs, and, you know, probably a little bit more information than we've kind of dove into it in the past. Does anybody else have any questions or thoughts, comments? If not, then I'm going to bring up Scott Varga. He is our new projects director at Summis. And, you know, as I kind of introduced at the start of this, we shifted our capital plan. We shifted from acquiring assets to driving value within the fund, reinvesting in the assets that we have. So there's 4 key projects, and Scott's going to come up and talk about those. Don't worry, you'll see me talk again.
Well, good evening, everybody. So I'm Scott Varga, and I am just joined the Summis team at the end of August. So I'm super excited and honored to be here and ultimately leading the projects team. So our projects team is actually now at 4 people. And that is amazing for this team and basically the composition that we now have. So Craig Zacharias joined the team just in September as well, who brings an amazing amount of wealth in construction and constructability. Art, you can't hear me? Thank you. Is that better?
Yeah.
Beautiful. And then so we have Nuha Damag, who brings a ton of institutional project experience, big transportation projects. And then with Timothy, the unbelievable technological ability that we have, as well as the day-to-day experience running this whole project, team from day one. And I'm really, I just can't believe what we're gonna be able to build out with this team. And part of the theme is really looking at projects more holistically. So being able to look at the problem with different and more inventive eyes, and ultimately to deliver on the mandate that we have, which is going to be achieving the metrics that we've been talking about while building unbelievable quality projects and ultimately the financial balance of it all. So today we're just going to talk about the 2023 cap plan capital projects. We're going to run through the 4 that are up on the screen, and then we're going to take a deeper dive into Outpost itself because it's such a great news story. And please, if there are any questions, if there's any technicalities, please do just put up your hand and I'll happy to answer any of that. So starting with Decade, which is the top left image on the screen here. So this is ultimately is an industrial project, and this is a building that we bought in 2020. So the building at the time was full. However, with a vacancy, it actually created an opportunity for investment. And this investment was mostly functional, a little bit aesthetic, and has basically created the ability to charge back the improvements over 7 years through the operating costs. So we have an improved asset, we have something that has greater leasability with that vacancy, we have a tenant that's very happy with it, and then we have an improved asset at the end of the day. Wolseley, so the building on the far right with the red cladding, so this project is in Medicine Hat. And so we bought this building in 2022, and part of the strategy here was to understand, because Wolseley had been on the site since the early 2000s, we wanted to know what would make them happy. What were they looking for in the property itself? And so they came back to us and they wanted a few things. So some site improvements. They wanted additional 750 square feet added to the building. They wanted an additional loading bay. So we said, okay, yeah, we can make that work. And ultimately, this project has been financed between. So it's a split between Cal and it's a split between the tenant. And it's really a win-win back to Cal because we've added square footage to the lease, we've increased the cost back of rent to the tenant, and we've got a new term in place. Now Wolseley has been a very interesting tenant to work with. And I was, until yesterday, I had this much good news, and now today we have a fully executed deal, which means we have that much greater news for the fund itself. So we're really, pleased with that, and that just, speaks to the testament of the whole team pulling together as we work through these projects. Warehouse Square, so the black image in the bottom left-hand corner of the screen is an absolute visionary project that I'm so excited about because we're just at phase 1 of this. So you might know this project. The site itself is an unbelievable anchor site just south of the highway north. It's the kind of the anchor north site of Warehouse District. And we have an opportunity to really lead the charge architecturally from a placemaking perspective, from a pedestrian perspective, and then even from a destination perspective with our architectural language and how we're going to leverage a whole bunch of key pieces on this development itself. So we're breaking, because the site is so large, we are breaking this up into phases. And so as of right now, phase 1, we're moving from the east side of the site to the west side of the site and focusing on the 2 retail buildings that are there. So we're going to, if you can picture with me, the Dollar Tree building, the former Dollar Tree building. So that is going to be transformed and fully rewrapped, and with the new tenant that we have in place. All I can say about that tenant in particular is that it's a family-oriented arcade event space. So it's going to be super cool. It's going to be bringing all different types of people to that site, which is really quite positive. And it's going to have an amazing upgrade from the exterior as well as the interior from the tenant side of things. And then switching over to the Soundgarden building, if you can picture that to the east, that's going to be demised up to 4 CRUs and then again fully rewrapped. So just those 2 enhancements alone to that site is going to become a small showcase over the longer term of the overall site development. And we're taking some lessons learned into this project overall. coming from Post and leveraging our relationship with the city and some of the lessons learned there around tax funding, access to granting, and really enhancing some of the public, actually the public placemaking space and opportunity for different ways to truly connect moving south as Warehouse District evolves. And again, we want to be on the front foot. We want to be the ones that are really leading and influencing how that overall development grows, because we have, basically we're first in. And so we're taking measured steps, we're de-risking a lot of the site overall, and we're going to be iterative, and we're going to learn and grow with the market as we go along. And so this is going to be a really big one to watch, and we're going to be excited to continue to update Cal overall. And there's going to be more and more exciting things coming from this one in particular. So I want to talk about Outpost, and I zoom in on this one. So, oh, sorry.
CRU, I think that's $100.
Oh.
Well, so he's discounted if he's able to find it. Well done, thank you.
Do you want to reiterate that? Commercial retail?
Yes,
unit?
so CRU, commercial retail unit. So I was referring to the demising of the Soundgarden building, and I said that between 3 and 4 CRUs. So yes, well played. I like it. $100.
That's 400.
That's right, one per demising.
Yes.
Yes, very good. I like it. Okay, Outpost. So Kendall spoke to you about Outpost at the AGM, and it was already a good news story. So the purchase price ultimately was at a fraction of what the original retail or listed price was. And so we've got, this good news story just keeps getting better ultimately. So closed the purchase deal in January 2023, $3 million. We've been working through a development plan of $8.5 million. And we've now been able to, confirm 75% occupancy throughout this project. And this is actually something that is going to be, if you look at basically we've got a 75% occupancy, total rent of about $1.1 million on an annualized basis, which is basically making the value of this building somewhere between 14.5 and 16 mil, off of an original investment of 1.5 of cash and purchase price. So we take something that was already in the ground, was already distressed, already had kind of a bad reputation, was on sale, and we turned it around in less than 18 months, all said and done, when we're going to be completely done with the site development in spring. Additionally, through our strategy, and this is where I'm talking about, holistic view of projects, the repositioning of this asset and the remaining 25% of leasable space, what we did strategically was actually bought the neighboring site adjacent. And so this allows for greater circulation, basically greater usability of the site to the east, and then it's going to have greater value to the project and asset for the long term. So just looking at things a little bit differently, really protecting the cash that goes in for that long-term return, this is a perfect example of a project that we're proud of, and it's going to be paying dividends for many, many years. Plus, it's also going to be a beacon to this area. It's going to spur on additional opportunities for the fund as well. So this is that platform advantage that we're talking about. By taking that holistic view, by bringing in the whole team and looking at a problem from all sides and trying to figure out where is the most value to unlock and how do we do it instead of somebody else. So we're really proud of Outpost, and we see this going to be basically creating opportunity for the fund for the long term. So those are 4 projects that we're excited to talk about as of right now, and we're going to be talking about a whole bunch more projects come 2024 as well. So if there's any questions, I am happy to answer them. Otherwise, I will turn it back to Andrew. Thanks.
Okay, so I didn't realize that after both times when I get to speak, it's after kind of more interesting stories, Kendall with the baby, and all the projects that we have underway. And again, I'm going back to economic review. But yeah, I just wanted to take a quick look at this presentation, just, look at interest rates and inflation and just demonstrate how they affect the commercial real estate market. So core inflation has been running between 3.5% and 4% for over a year now. You may go to the grocery store or the gas pump and say, oh, well, inflation is much higher than that. Why does the Bank of Canada keep saying core inflation is 3.5 or 4%? This is because the core inflation is an index that doesn't include food and doesn't include energy. They don't include these two metrics because just of their general volatility. So the Bank of Canada thinks that the best measure for where inflation is headed is core inflation. And they've also made it very clear that their goal is to get core inflation down to 2%. Now we know the main lever that they use to do this is interest rates. And we can see at the bottom of this chart here, interest rates during COVID at historic lows at 0.25%. And then we can see a rather steep curve as we get up to where interest rates are sitting at right now, where our overnight rate is at 5%. But we can see, and I want you to remember this curve because we're gonna go back to it in a minute. But we can see that this is where interest rates have gone in the last year and a half. Now, how does this really affect commercial real estate? Well, you have an asset and you have this high interest rate, high inflation environment. When you have an asset, you want an investor's looking at buying this asset. He's looking at the debt associated with that, and those high interest rates really bite into his returns. And in general, that's going to push the price of an asset down. Well, on the other side, you have these inflationary pressures, right? You have the cost to rebuild the same asset is much greater right now. The cost of raw materials is higher. We have population growth, that's increasing demand. So this is the high inflation, and that should be driving prices up. But really what it's created is a general imbalance in the market as buyers and sellers are not quite finding prices that each of them can live with. So the important thing to note though is that regardless of the economic environment, there's value to be created and there's money to be made, which is where we kind of move to. Now this slide is titled Cal Foundation, but really this is the key foundational pieces for any investment real estate. You have asset values, cash flow, and your management values. Doesn't matter what real estate you're investing in. If you can distill your fund or your fund down or your property down to these three things, you can generally determine the strength. Two of them, of course, are concerned with the assets that are currently in the fund, asset values and cash flow. While management looks at, hey, how do we drive asset values? How do we increase cash flow? And then on the other side, hey, it's the forward-looking piece where we're looking at what are we looking at acquiring in the future and what kind of assets are we looking at purchasing. So I just want to dive into these three kind of core values for a real estate fund and see how our KPIs that we talked about earlier kind of support Cal's three foundational pieces. So the first one is asset values. The assets that we have in Cal, we own them, we bought them to own, we bought them to reinvest and to strengthen them. And really that's the first part of Cal's strength here. We have a proactive plan. Scott just mentioned it, but we're not sitting back and kind of waiting for time to degrade these assets. This proactive approach means that we're always re-examining the assets that we have in the portfolio, looking for hidden value, and always trying to maximize really two things: current cash flow, driving rent growth, and asset values. Rent growth is really the best hedge that you have against inflation. And although rent growth is going to affect the cash flow that we'll talk about in a second, really the fact that we see these inflationary pressures driving rent growth and making and increasing rent across the board means that we can have a lot of faith that the assets that we currently have in our portfolio are going to maintain their value and be primed for strengthening. So the two KPIs that we talked about earlier, key performance indicators. The first one is WALT. That's our weighted average lease term, if you'll remember. And a WALT, as long as 6 years, really provides comfort that the values that we have in Cal are not going to be subject to a bunch of vacancy. The other one is cap rate. And now this is where we can see our target cap rate coming in. Because the projects that Scott talked about are not just designed to, oh, we're going to make this building look nicer or make this building look nicer, we're going to throw $1 million here. These are very strategic, very proactive plans that we put in place to drive the asset values that we currently have in Cal. So this is why when we say we have a 6.64 cap rate, true, that's our current cap rate in Cal, but we're looking at targeting an 8.14 cap rate over the next, in the short term, between mid 2024 towards the end 2024. So these projects that we have are very targeted in increasing that cap rate. This all ties into our asset values, with the final advantage that we have being the due diligence and the process that we have when we purchase our assets. Maintaining, you've heard Kendall talk about this many times, and you've heard me talk about it as well, but maintaining that strong entrance price on an asset is paramount to what we do. So we're gonna take a look at industrial cap rates over the past couple of years and retail cap rates over the past couple of years and see where we purchased assets opposed to where the market caps were. So on this slide, you can see industrial cap rates for the past, about 4 years there. Both the trend lines at the bottom are Class A and Class B national averages for assets. Now, a little caveat for both of these slides, these are national averages. This isn't necessarily Lethbridge. What something trades for in Vancouver might be different than what something trades for in Medicine Hat or Lethbridge. But these are the national averages, and you can kind of see the spread that we have between our industrial assets that we bought. Now, this is a very intentional buffer that we put in place so that, as the market moves, as cap rates maybe go to increase, we have a buffer, and the values that we have in our fund are going to stay strong. The other thing I'd like to note is that you can see where the peak is in this market, Q1 2022. If we look back and we think about the interest rates, when did the Bank of Canada start cranking up interest rates? Q1 2022. You'll also notice that instead of a real steep curve like we see with the interest rates, this one's much more gradual. So those are both, the cap rates are correlated to the interest rates, but they're certainly not tied to the interest rates. As I said, here's our retail cap rates as well. Again, you have the trend lines at the bottom, and you can see where we bought Fairway and Hillman, and Warehouse Square is right off the map. We didn't have a chart big enough to put Warehouse Square in there. But again, this kind of demonstrates the value. This demonstrates the value that we have in CAL and our position when we purchase these assets. So the last thing I kind of want to touch on with asset values is really our conservative approach. When we buy an asset and we bring it into the fund and we get what Kendall calls on sale, or we get a good price on an asset, we don't take that, bring it into the fund, and then jack up that price. Your unit values right now are sitting at $13.60, and those unit values are set on the foundation of the asset values and how we internally value those assets. When we bring an asset into the fund, we don't increase the price on that asset for at least a year. We say, hey, this is the price that we got it for. We don't want to artificially increase the asset values or the unit values. And we want to make sure that, hey, when we go to dispose of an asset, when we, even if we were to sell something, that we're getting what we said in our internal valuations that we present to you at our AGM, we're going to get that for that asset. Oh, I thought I had some relief from the sun there for a second.
Get shorter.
Scott, you want to come back up here? So that kind of ties into the second foundational piece, which is cash flow. So cash flow in a portfolio provides the stability to the changing pressures, and cash flow is what allows us to pay distributions. It allows us to reinvest in our assets, and strong cash flow reinvested is really the best way to see undiluted growth inside of a portfolio. So the KPIs that we talked about before and that really tie into cash flow are the four that are up there. We have loan to value and the weighted average interest rate. Both of these demonstrate that we're very well equipped to handle the rising interest rate environment that we find ourselves. Our WAM demonstrates that we have a really nice runway to ride out the next couple of years if and when we need to. And the DSCR shows that we're going to be in the position to fulfill our debt obligations regardless of where interest rates may move. Now, at the bottom of this chart is really kind of our management advantage when we talk about cash flow. So we haven't acquired any assets over the last year. We talked about the projects that we've done, but we've also done 9 renewals, lease renewals or new leases over the past year and a bit. One of the things that we're constantly focusing on is driving rent growth. In a high inflationary environment, there's opportunity to increase rent if you're presenting that to the tenant, and if you're forceful and focused on making sure that you're getting the best value that you can for the space that you have. So we really focus on creating, like, first of all, we know the market, and then we're focused on creating that rent growth when we can, finding a win-win with the tenant. And, you know, we're not interested in increasing rent growth by, you know, 2.5%, 3%, like you might see with some other, you know, funds or other leases. We're interested in driving that to the maximum that we can. So when you're looking at and that's where the two numbers at the bottom come into play. So if you're looking at what the last rate was on the previous lease compared to the first year of the new rate, we're up 12% on all of our, on the 9 new leases and renewals that we've done over the past year. And when you're looking at the term average over the next 5 years, you're talking about a 19% increase over the last year as the baseline of that lease. So overall cash flow position in Cal, you know, I would consider to be very strong. And the last one on that for the foundational pieces of real estate is our management values. Excuse me. Like, does management team execute on their mandate? Do they sit on assets and let them kind of degrade over time? Are they out there driving rent growth? Are they transparent? Are they trustworthy? These are things that we like really talk about weekly, and we try to demonstrate them daily. You know, recognizing that there is an inflationary pressure out there that creates an environment for rent growth, and then being proactive that when there aren't opportunities to buy, we have the foresight and we're looking forward and we say, hey, we don't think there's opportunities to buy, but strategic reinvestment can be an amazing way to increase the value of our fund. Both of these are very core to our management principles, and they all further accelerate the rent growth. And keeping all of these in line with our mandate that Kendall talks about at the very start of every single meeting. We protect our cash flow, we manage our debt, and we curate a diversified portfolio. So
just a quick point and maybe a question. I direct this question to Kendall, and I see Doug Mareskis here tonight. We do the best we know how to value the property at what we think we can actually get if we put it on the market.
100%, that is the best plain way to say it.
But the only way we can check if we're on track or if we're doing it right is to sell the property to see if we actually get what we think we were going to. But the other option, and I know we do it, is to have it appraised.
Yeah.
And my question to Kendall and Doug, if you don't mind, how often does the appraised value reflect the actual value? Like, is it within usually a couple percent, 5%, 10%? Because I know some appraisals are very small.
Depends who's doing the
Yeah,
appraisal.
some appraisals can be up to lunch, so we
No, so that's my question, is how often, like, we
I got
do
this one.
use appraised values to try and make sure we're in the ballpark, right?
Yeah, absolutely.
How
So,
close are they?
well, you know, you're right. Some appraisals, you can play with some appraisals, and really that depends on who's doing the appraisal and how you're approaching them for the appraisal. So if we're going to get an appraisal for financing or for, you know, typically for financing, we're going to the appraiser and we're saying, hey, did you consider this? Did you consider this? You know, like, let's get this rate up. But internally inside the fund, we do appraisals on each of our properties every 3 years. We use Colliers up in Calgary, and when we do these appraisals, these are for our internal use, and we don't approach them like that. So really, when I talk to Mark up there, I say, hey, Mark, we're doing these for our internal evaluations, so I want you to give me as accurate as you can to the market that we're sitting at right now. And that kind of ties into, you know, our transparency and the trust that we, you know, hopefully instill in all of you.
The other factor to that, you know, or I'm glad that you mentioned that, would be, well, how do we weigh in what the appraised value is versus what we value internally? So to give you an example, Sunridge Village, the last appraisal that we had on it was 11.2 million. We value it internally at 9.94, right? So we got an appraisal. The appraisal is based on market rents. It's based on market cap rates, but I wouldn't buy that asset for $11.2 million. So I don't value it at $11.2 million, right? So I think that's part of, you know, one, we want to make sure those numbers are realistic. We want to make sure the market numbers are fair. We want to make sure the cap rates are fair. But then we're going to look at it and say, well, would I buy that for that? And then we'll use that in a weighting to determine our internal valuation. So that's one example, $11.2 million appraisal. Internally, we said 9.94.
Kendall, I wrote this.
Okay, I can fix it for you.
Okay, yeah, you go. I'm done anyway, so I like to break things right at the very end, so I don't have to fix them.
Thanks, Andrew. Presentation mode. Boom. Look at that. Tim has taught me well. Thank you. Tim has taught me well. So,
Can I ask a question?
yeah, of course, totally.
What percentage or are all of your leases triple net? Like,
Oh,
is
yes.
there-
Yes.
They're all triple net.
Yeah,
There's no
so-
exposure to.
Well, except for multifamily, right? So multifamily, and you saw that Sunridge Village at the very first slide in terms of multifamily. And this is part of the reason why we build a diversified portfolio, right? Each of the different asset classes have pros and cons. So residential, you've got usually 12-month leases, right? So you can catch up with rent growth quicker than you could in other assets. Let's say VersaCold, industrial warehouse. We have a 20-year lease. Provides a lot of stability, but obviously there's no opportunity for us to catch up on rent growth. So multifamily, it's not triple net, those are gross leases, but we can adjust them quicker. And we were actually performing over budget, right? So again, rent growth is pushing faster than expenses. So we were actually able to perform over our expectation. With all the rest of the properties, unless we buy a property that has gross or modified gross leases in place, they're all triple net. And our triple net leases are built very favorably for a landlord. And the reason we can do that is because we build deep relationships with our tenants, right? So one thing, and many of you, there's some of you that, you know, we're clients of mine in the brokerage world, is that a tenant is only going to sort of pay what they can pay, and they're only going to trust you as far as the relationship that you build with them. And so we build that relationship with them to say, hey, we're going to keep your rents as affordable and as close to market as possible, even when market moves. But we're going to recover the expenses off the property through that. So I would consider all of our leases, especially the 9 new ones that were renewed and put in place, quad net of, you know, we're even recovering costs on properties that, you know, maybe some landlords wouldn't. And the reason that we can do that is because of the relationship with the tenant and the fact that we're proactive in planning it. So Decade, quick example there. Normally, capital improvements to a property is not something that you're recovering in your operating costs. However, maintenance of a property is something. So, you know, they were paying $30,000 a year, every year, to have a grader come out and regrade the parking lot because it would get rutted and trucks are going in and out and they make a mess. So we went to them and said, okay, you know what? We would like to redo this. We're going to make it better for all of you as users. It's going to cost us some money up front. We're going to spend the $900,000 that Scott talked about, put capital improvements, do new loading dock pads, pave out the site. But we would like to put this back into your operating costs at $30,000 a year instead of you just paying the same old fee to maintain the site that you've been doing forever. And they said, oh yeah, that sounds good. So again, being strategic, being proactive, including an expense that wouldn't normally be included in operating costs, while at the same time improving the actual asset, right? Win-win. So that's the way that we would look at a win-win. Okay. Any other questions?
Kendall, triple net, what is that?
Good call. So triple net, to be honest, I don't know where this phrase came from, but it's been in real estate forever and it doesn't even make sense anymore. So what it used to be is you would have single net, which is property tax, double net, which was property tax and insurance, triple net, which was property tax, insurance, and maintenance. Well, what is maintenance? You know, so that is the one that, you know, has gotten quite large over years. So triple net, in theory, means property taxes, insurance, and maintenance on the building are paid for by the tenant. Really, the best way to describe it today is it's a fully net lease. So when we agree to a lease payment that the tenant's going to make, that is solely a return on our invested capital or a value of the asset. The net, triple net, double net, quad net, whatever net you want to call it, operating costs, CAM, there are way too many words for it. That's the expenses of the property that we're passing on to the tenant. Now, we have a great finance team and they help us make sure that we reconcile those properly to give the tenants a budget, right? So we're doing budgets now. We'll send the tenant a budget in advance of next year. They'll pay those expenses and then we reconcile them at the end of the year. And so again, that transparency and the detailed accounting that we do to deliver that is what gives the tenant the trust to say, okay, fine, we'll agree to pay you your expenses. If we didn't have that, then they might, you know, fight tooth and nail to say, no, we want less net, we want gross, et cetera. So it's a bit of a two-way street.
And by the way, you didn't define CAM right away.
This is good. I appreciate that. So we got 3 now. So CAM, common area maintenance. So if there's common area on a property, right, which some properties do, generally speaking, the parking lot, right? That's the simplest version of CAM. In a building, let's say like Post, right? You know, full service office complex. We got hallways, corridors, meeting rooms, amenity rooms. Well, there's an expense to running that and maintaining it, and so that is CAM, common area maintenance. Thanks, Dave. I'm taking that out of one of your commission checks. Okay, it's good, that's a good question though. Any other questions on value, performance so far this year? No. Okay, so where does that leave us, right? So Andrew talked a bit about, value of the fund. So at minimum once a year, we do a full valuation of the whole fund, right? And there's not an enterprise value attached to that. We just take the value of the assets, subtract the debt, the liabilities, divided by outstanding units, that's the unit price, right? So there's not a multiple factor on it. We're not putting a factor on future cash flow. We're just saying, what is this currently worth? And so in the past, we have not changed the unit value on a mid-year basis, which this is our mid-year fall summary. And we're doing the same this year. So 1360 stays the unit value. However, we want to update you guys on distributions. So we will update that unit value at our 2024 AGM. And depending on where we're at in terms of leases that are signed off, where a project is completed, we also don't take credit for a project until the project's done. A project to be done, we have to be making money on it before we change the value, right? It's not like, oh, we're going to do that next year. So this is the price today. We got to wait till it's done, then we're going to realize that value. So this will update at our 2024 AGM. I would expect that it will be a favorable number given the value creation in a project like Outpost. But we don't give away our secrets. So we can talk about that over a drink after. 2023 bonus distributions. So Andrew mentioned the sort of consistency of our monthly payment. We want to make sure that all of you know that what that distribution is set at, you're getting, right? And a prime example of that is through COVID, right? COVID hits March 2020. We go through 6 months of times that no one really understood or knew how to manage. We were able to pay out our distribution as planned through that entire process and then still pay out a bonus at the end of the year because we're doing cash flow projections and the number that we give you as a base distribution, we know is same. So for 2023, we're going to pay out a bonus distribution, but we don't want you guys to get too comfortable with us always paying out bonus distributions and multiple bonus distributions. So this year we're going to pay you one in December. So you'll get a double distribution for December. And that'll bring our total cash returned to the partners on the current unit value to 5.5% for 2023. Based on those of you that have invested with us since the very beginning, we're now up at 7.54%, right? So again, every year we're calculating those distributions based on the current unit value and not what you invested at. And so that return, that cash return on original investment continues to increase. We're also happy to announce that for 2024, we'll bump up that base distribution. So we'll take that from $5.80 per unit per month to $6 per unit per month. And our goal is to keep increasing that year after year. So that way you guys have extra cash flow attached to it. Any questions on valuation or distributions? No? Okay. So strategic partnerships. So this is something that we talked about for the first time at the AGM, and I wanted to give you guys a little bit of update on this, then what we're doing next, and then we're done. So strategic partnerships are a way for us to invest in a minority position in other projects, right? So now we do this for one of two reasons. One is that a project that we have interest in participating in doesn't fit the core mandate of the fund, and so we're not going to take on all the risk attached to the project. Two is that we're looking to learn a little bit. So you guys have heard me say that I don't like to put money somewhere where I don't have a relationship or a knowledge advantage, right? If someone else is playing in a market and knows the market, well, why would I try and compete against them unless I have a relationship or a knowledge advantage? So our expansion into Calgary is primarily driven by feedback from you guys. So a couple meetings ago, we did a survey and we said, hey, as we grow, we're going to run out of things to buy in Lethbridge. And so where do we want to go? What is the group's mandate for where we would want to expand? So about a third of you said, we like Lethbridge, we can drive by the properties, let's do Lethbridge. About a third said, hey, Alberta is interesting, Alberta. And then about a third said, let's go to Western Canada. And so we take that feedback and we say, okay, based on the tolerance in the room, we're going to expand conservatively into Alberta for now and see what we can learn. And so we look at Calgary. Market makes a ton of sense. It's doing very well right now with population growth. And we say, okay, who are some relationships that we have in the market? Who is running a strong investment program? Let's partner with them, right? And so our first 3 investments in Calgary, 2 of which are with NREG Capital, 1 of which is with Round Square, are operators that we think are very, very strong at what they do in a very defined niche. NREG Capital manages money for Sun Life, for Manulife, for GWL, but they're a very niche small shop, and they do investments out.
GWL?
I don't even know what GWL stands for, to be honest.
Great West Life.
Oh, okay. Glad you guys know. It doesn't count if you guys know the acronyms. So they're a life insurance company. So yes, Great West Life. I did know that. Great West Life, Manulife, Sun Life. So they're big life insurance companies and pension funds. And so they'll place money with these guys to manage by the hundreds of millions, but they have a really strong team. And so they'll do smaller projects outside and they'll raise outside capital, generally through their own relationships, their own networks, just like what I'm doing here. And so these are 2 projects that they started. They're in office, which is a bad word nowadays, but there is a tremendous amount of money to be made in office when it's done right. And we've learned some of that playbook through our project at Post. And so in building the relationship and giving some notes as to, hey, this is what we're doing, this is maybe what we would recommend that you guys do, combined with their experience in the market, they were able to purchase 2 assets off market that were too small for these life insurance or pension funds. And so the price is, hey, here you go. And we were able to participate as a minority investment. But at the same time, we get to learn boots on the ground, information, data, how are they managing it, what's their deal pipeline look like. And we're not necessarily going to go in and compete with them, but we'll look to continue to grow that relationship to the point where maybe it's a JV. So again, we took your feedback and we said, okay, we're going to expand. Joint venture. So joint venture would be, okay, we're not doing it on our own. We're not doing it via minority investment. We're going to do it together, which is a joint venture. Thanks a lot. And then Round Square is a company that has been doing a great job with multifamily housing, which is something that I'll mention in a little bit. Housing is definitely a hot button topic, and it's one that we are looking to get into in 2024, and we've got a bit of a plan to do that. And so then what better way to learn some of the ins and outs by participating with a group that's done it and done it well and learn what some of those lessons look like. In Lethbridge, the participating partner is primarily Summis, right? So these are Summis-led partnerships. Michael Kelly, who's the former general manager of land development at the city of Lethbridge, is a co-partner in the Frontier Land Development. And our thoughts there were, hey, we're going to be building property or projects that we ultimately would like to own. Let's invest in a minority way into something that Summis also controls and has influence and input on. And let's participate in a small way, right? And so then now projects that we're advancing, you guys all get to be part of in a small way in the gains and also in the lessons. So Frontier is land on 43rd Street, industrial land. You'll see them out there with the tractors, scraping it all up. We expect to have roads and services done this year before the snow flies, although that will not happen because there's snow flying next week. And so they'll need that to melt and then they'll finish it off. And we're selling parcels. And we've already gotten tenant leads, which would lead to future projects and cash flow that we're expecting to complete for next year. North Point is fully entitled, which means we have all of our base development permits in place land for some more industrial facilities. And we're waiting for a key anchor tenant to kickstart that, one of which we're in discussion now. And so that gives you guys a sense of the things that we're looking at, but we're participating in a minority way. So strategic partnerships as a whole won't make up more than 5% of our total fund. Right now we're at 3.5%. And so again, these are not necessarily in the cash flow mandate of Cal, but they allow us to dabble and play and realize some of the upside in a smaller fashion. Any questions on our strategic partnerships?
What are the
Green bars?
yeah.
So there's more info on this in your guys' booklet, but what we wanted to do, and we're actually still working through this, is how do we want to report on these so that way you guys know what's happening? And so on each of these, we have the amount that we've invested, so that way you guys know what that looks like. The green bars are a bit of a progress bar. How far through the project are we? right? So Frontier, we're nearly done completion and then we just need to sell it through, / I need to put some pressure on Mr. Doug, maybe Jeremy, to help us sell through those parcels. And then what is our exit strategy? So here it's to sell. For North Point, where we've just started it, our plan is to hold. For Vintage Park, 1122, and for Round Square, sell, hold, sell, right? So what's the plan? What are we doing with that capital? And then the investment amounts are decided as well. And there's more details in your guys' fall summary book. Thanks, Nancy. That's a good question. Okay, so what's next? So I just mentioned it, housing. So the very first project that we funded, Sunridge Village, multifamily. I do think this is going to be a very hot button topic in real estate, but also legislatively with governments in terms of, okay, we've got, expensive housing, interest rates are rising. Where do we put the people that are coming into Alberta? We've got a bit of a plan for how we plan to implement housing for the next phase of Cal and for Summis. And we'll talk more about that in 2024. But the short version of that is we need some economies of scale. So one of the things that we learned with Sunridge Village is that property management is a key bottleneck for us. If we want to manage to our standards, we're probably going to have to figure out how to manage it ourselves, because we build relationships and we keep track of accounting in a way that some firms just can't handle or can't manage. So to do that, we need economies of scale. So we need to be able to get over 150 doors for us to have that make sense. And up until now, there was just more return and more leverage available through commercial avenues. Now we see an opportunity to, sort of strike on some multifamily opportunities, given some of the government funding and granting for creative development that incorporates technology, that incorporates placemaking, that we can put residential beside existing commercial developments. And so that plan is what we'll sort of unveil to you guys next year, along with the first couple of investments that we would plan to make. And that will end up returning us to our roots and grow out that piece of our pie, which has fallen down to about 12%. The Summis Manual. So you guys heard me sort of provide some thanks back to the Summis team for the fact that they've stepped in. Andrew on the asset management side. Scott now taking over on some projects. They've done a great job over the last 6 months. Andrew and Timothy also actually just celebrated the 5-year anniversary with Summis, which is crazy that they've put up with me for that long. But we've now crossed that 5-year milestone, and we've learned a lot of lessons. There's things that we didn't know that we still don't know, and so we've been compiling all of these into a manual or a guidebook, some of which we'd like to share with you guys to say, hey, this is how we run properties, this is how we run our fund, this is some of the secret sauce, and also allow us to iterate and improve on that going forward. And so by this time next year, we expect to have the first full version of that completed that outlines our magic, our initial playbook, and the standards that we hold all of our properties to. The third one on the list is one that I'm excited and proud of, and I think one that will matter to all of you as partners. So I'm a believer that a lot of people kind of discount or don't fully recognize the value of uninterrupted compound growth, right? It's one of those growth curve things that's just hard to comprehend until you've seen it. And I've been fortunate and lucky that people have brought me into businesses and brought me into projects and brought me into properties over the growth of my career. And we want to make sure that we can do that with the Summis team. And so for 2023, we put in place the first Summis team investment program bonus that allow everyone on the Summis team to actually earn part of their bonus and become partners and owners inside the fund alongside all of you, right? And so I think that that's meaningful in a way that everyone who's looking after your assets day to day, everyone who's looking after your tenants day to day, everyone who's looking after the budgets of your projects, well, they have a tangible piece of value for them invested right alongside you, right? And that is a unique advantage for us, is that we act like owners because we are owners. And that this will be the first year of putting that together, and it's something that we're quite excited about. Now, last two items. I remember sitting down with Art and Darcy when we were talking about, okay, well, what are we going to do in 5 years? And I told them that we would buy or have a fund with $100 million in assets in 5 years. And the slight disbelief, slight chuckle, but we're excited to be along for the journey in their eyes was definitely visible. And we're closing in on that milestone to close out this year. Once we realize some of the value from our projects, we've actually got a couple of acquisitions on the table now that we're excited about. Now that people have come to a bit of realization on what the economy will look like over the next couple of years, we're sort of in striking distance of that 100 million. So we've got about $3 million worth of liquidity inside the fund today. I would like to finish the year in more of like the $6 million range. So for the existing investors, we will open up a fundraising round from now until the end of the year before we change unit values to put in that roughly $3 to $4 million worth of capital. And that'll ensure that we've got some dry powder to finish off the year and buy some of these acquisitions that we have in the hopper and make sure that we cross that $100 million threshold. Although I have a backup plan to make sure that we hit the $100 million no matter what. But it's pretty exciting. It's neat to see that growth. It's cool to see the value that's been created inside of the fund. And we appreciate the fact that some of the partners here have been along since the very beginning and have contributed with us every time we've come and said, hey, we'd like to build up the capital pool so that way we have capital to put back into new acquisitions. And that is definitely one thing that this year has taught me on our final point is enjoying that journey. Some of us did hit our 5-year milestone this week actually, and I almost forgot about it until Raymond and some of the team brought a cake out and said, hey, did you know it was in the calendar? It's been 5 years. Is slowing down sometimes to review what we've done, what it looks like, who has been involved, what is attached to the group in terms of team and partners, and enjoying that journey, which is something that I was reminded of very much so this year. So I appreciate the fact that we've got an advisory committee, we've got Art, we've got Darcy since the very beginning, we've got Eddie, we've got Darren, who add expertise and insight to what we do as we do it, and a Summits team that is always there and contributing every day to what we do. And when you have a sick teething baby, to make sure that you get a little bit of sleep as well. So I think we've covered the updates over the last 6 months for our fall summary. But any of the Summits team is happy to chat about any of these in further detail. What are we up to next? What do some of the strategic partnerships look like? What are the project updates? In more detail, we're here. We're happy to chat with you. I want to do kind of a last call for questions to see if there's anything outstanding that you guys want to know. And then we will wrap up, and there's food and drink still available for everyone. So.
Sorry, it's my first time here.
Yes, totally.
So what is Summers and what is CAL?
Yes, that is a great question. I have a feeling that you were going to ask that. So CAL is our fund group, right? So that's the investment collective of all of you as partners, including myself, right? So for me, the compound annual growth is important, and this is my largest single investment as well. But the separation between CAL and Summits is that Summits is the designated asset manager, right? So there's a manager on behalf of the fund that manages day-to-day, that manages the accounting, that does the property management, that does the project management. That's what Summits is. So Summits is an operating company that acts as the designated manager for the fund, which is all of us as partners.
One more question. You explained the effect of interest rates.
Yes.
On the funds, but is there any effect of the market, stock market, or geopolitical issues that's happening right now?
That's a great question. So one of the reasons why I and some of the others choose to invest in non-public entities is because they're not subject to the same volatility that a public entity would be, right? And sometimes, well, and many, if you follow like Buffett or Charlie, like they talk about the market is sort of the reflection of people's attitude and emotions at the time, not necessarily of what the true underlying value is. And so in a privately traded fund, obviously we're still subject to the same market conditions, and we would need to value against and work with the same market conditions, but we don't have the same volatility attached to what our value is worth because we value it internally, right? Now, we also don't have the same liquidity because it's not publicly traded and you can't just buy and sell it instantly, which is why we hold liquidity events a minimum of once a year to allow people the opportunity to come in and out. Now, the impact of the market will definitely be felt. Interest rates are definitely felt. Interest rates, I think, is the most unique one with real estate because real estate is attached to leverage, which is attached to interest rates. And we can make money in any market with interest rates, provided we have a buffer, as long as we're proactive, right? So interest rates have really never gone up as quick as they have in the last year and a half. And so then it's like, okay, there are groups, and I know of groups, even in Lethbridge, where they have all floating rate debt. And so they have no buffer, right? They have no buffer in which to invest in their properties, drive rent growth, and match inflation. They're just, to be frank, in trouble. And I don't think that we've seen the pain that I believe is out there. I do think the next 2 years will be challenging in terms of volatility in the market. We'll see. We had the saying during COVID of, that you won't see who's not wearing clothes until the tide comes back in. And I kind of thought the tide would come back in, but it hasn't yet. I think that there are people that are underfunded, that are not being strategic, that that didn't think things through, that haven't yet cracked or broke. And when they do, that's when we'll start to see some weakness in the market, which will be seen in the public markets. But that's also where we'll then be able to see opportunity. And we're starting to see some of that, but I think that we'll see a lot more of it in 2024. So for us, it's making sure that we're ready, that we're well capitalized, that our debt's in a good place. So that way, as we see those opportunities, we're all over them, and we're well positioned to do so.
Question to the Calgary, the investors.
Yeah.
How many of you think interest rates are going to continue to climb
What timeline?
over the next 5 years?
5 years?
3 years. Let's go 3 years.
Yeah.
1, 2, 3, 4, 5.
2 years.
Just 2 years.
Yeah.
You made the statement that you've never, this is unprecedented increase in interest rates. No, it's not.
The speed of which they've gone up 475%. In my life. Yeah. No, I think that is a very real possibility that they, continue to crank. We're seeing the government prep legislation and sort of, I would say, pressure release valves in the housing market in terms of extending amortization, because I don't think they're going to let up on the interest rates. Oh, well, people can't afford this. That's not really their problem, right? Their problem is maintaining inflation, and so they're going to do what they need to do that.
There's a lack of confidence.
Yeah.
Stop printing money.
It's a general lack of confidence, and I think that's going to drive.
So with that being said,
Yeah.
Again, you raise a valuable point, Art. So then what's the position for the next 3 years for the investment group? How do you continue to go from, 100 million to 200 million to 500 million? If because let's be honest, there's many groups. Like this particular group that are equally as sophisticated. And we're talking just Western Canada. That can position themselves and maneuver and have relationships. And get deals done along the way. And not to be on the spot, because there's probably not a real good answer right now, because we're talking a lot of speculation. It's fair. But it's a conversation, right, that we're all having, is how do you position yourself to grow in a time that we're in.
And part of that, the short answer is, don't know. I have no idea what next year will look like. So I know as it approaches and as we see it come in, we build a plan, we update you guys on what the plan is, and we attack that plan. I think the portfolio that we've been able to build already with groups that had more experience, more capital, more this, more that, is impressive and shows that we've got our niche and we know what we're doing, and we'll continue to capture that piece of the market. As it comes, we'll see what that plan looks like and what we need to do to take advantage of it. But I think that you'll see rent growth and pricing and or rates crack, right? One of those will crack. And so then if you are pushing on, if rates don't crack, which I don't think that they will for some time, then you're looking at, okay, well, are we placing capital intelligently? And are we keeping up with where the market is moving for improvements and for rent growth? So that's what we're balancing. Now, you've seen the restraint in 2023. We told you guys in the AGM, there might not be assets to buy, right? If we have the option of growth and protecting the portfolio, we're going to protect the portfolio, right? So if there's nothing to buy, if we don't think that we can add value, if we can't build relationships, if we can't drive that internal cash flow return on an asset, then we just won't buy assets. So we won't sacrifice our performance for growth, but I don't think that those will be mutually exclusive, because when people are uncertain and people don't know what to do, there will be opportunity. Business needs to happen, people need houses, and so who's going to be there to be creative and figure out how to extract value out of it, how to deliver value? I think we're very well positioned to do that.
Yeah, and just my opinion, and Doug, you can probably comment or squash my opinion on it, but I think into this group, actually, it's almost the irony, you went from Lethbridge based and looking at other opportunities.
Yeah.
And so you've extended your vision beyond, which is fantastic. And in a normal climate, you can do that all day long.
Yeah.
But I think the irony in all of this, from what I can see, is that actually there's gonna be a little more opportunity here local.
Totally.
That you're gonna continue to maybe do what you did initially.
Yeah.
Longer term.
Yeah.
That's just my vision of it and how it might play out.
Yeah.
I don't know that. We're all, again, trying to understand it as we go each day.
Yeah.
But like, there's a frenzy of capital out there still.
Yep.
And it needs to be placed.
Yep.
And at the same time, Lethbridge is not often looked upon to place that capital.
Yep.
From some of the larger players.
Totally.
So you've established yourself and you've done that very well.
Yeah.
And I think you might be surprised by a second cycle of that.
Yeah.
I'm not here to promote that.
He's a broker, by the way, based in Lethbridge. So.
But I mean, I'm just talking you through a little bit as I listen to what you're talking about.
Yeah.
And, we forecast our cycles through about 2 years, as you know.
Yep.
And I mean, I think there's more opportunity here.
Yeah.
That might be overlooked by some of the competitors in your world.
Definitely. Yeah, we see that. And we've talked about that in terms of tertiary markets, right? So as we grow, there's an element of taking some of the playbook and lessons learned from large markets and bringing them to tertiary markets where there isn't capital, where there isn't teams, where there isn't local relationships. And that right now is our biggest advantage. So I think even as we look at our planning, we have some projects where it's like, hey, we want to do another 2 of those. We want to do another 3 of those. It's like, oh, well, we can do those right here. Like we can do those in Lethbridge. Is originally what I would have forecasted is how much we could buy or invest in Lethbridge. Now I'm like, oh, we could have 2-3 times that, right? Because again, our relationships get deeper, our network gets deeper, we see opportunities. There isn't as much capital playing here. Okay, well, let's seize those opportunities and be able to provide options for tenants in the market. So I would definitely agree.
And another thing that could be.
And we have the most relationship and knowledge advantage here, right? So
We do.
again, you've seen, even as we look at other markets, we don't just dive in to buy. It's like, okay, well, what is giving us the advantage to do this over someone else?
How many of us would be in this market today right now?
Mhm.
If we could get a GIC for 7.5%?
Mhm.
And that's another thing, if interest rates, and I believe interest rates are going to continue to climb for a while.
Yes.
I don't know, I know what I paid over my business career.
Yeah.
And 8-10% didn't look bad.
Yeah.
All those years.
Yeah.
And 14 and 15% was very much a part of my life.
Yeah.
So, but how many of us here would still be content if we could get by a GIC for 8%? How many of us are in this market?
Yeah. Well, it's not tax efficient.
And that's another little, who knows, right?
Yeah.
But it's just another fact.
And that will affect the return targets that we would have and what we would need to buy real estate at to drive our returns going forward, right? If you can get, as you showed, interest rates drive up. Well, GICs are kind of behind that. What people would expect from other returns is shortly behind that. And so that would implicate or influence what we would buy at and where we need to perform to be an attractive investment option. Now, one thing, I've had this conversation a couple times lately, is around the like, okay, well, if we have a risk-free rate or a GIC here, then why this, right? Or why that? Any investment, not just Cal. But I think a lot of the investors in the room think about, okay, well, then what, right? Well, what do I do after year 1 or year 2 or 3 years or 4 years down the road? How am I being taxed? What's the tax efficiency on that income? And what is the compound growth plan attached to not just the cash flow, but also the equity value attached to it, right? So the investors in the groups that made the most amount of money in real estate, provided they made it all the way through in the 70s and 80s, were in real estate, right? Because they were buying it when people said, hey, this doesn't make sense. Maybe they even had negative yields. That wouldn't be something that we would dabble in, but maybe they were willing to take short-term cash flow losses in order to be in an asset and own that equity value for the long term or through the end of the cycle. So that's something that we look at and we measure of, okay, well, where's our threshold? How long are we willing to buy at these rates or borrow at these rates before we pay off in order to get this equity growth over 5, 6, 7 years? And as many of you know, the tax efficiency of our structure, where you're receiving distributions currently and not paying tax on it, versus a GIC or another cash-based investment where you are getting dinged with taxes every single year, is a huge difference. The flexibility to reinvest or not reinvest is a huge difference. The compound growth of being able to set it and leave it and have us compound it for 10 years versus a GIC for X period of time, which is then cashed, and now you have another problem to figure out what to do with it and where to put it. Those are the things that will make Cal and real estate investment in general compelling going forward, and I think we've got a great platform to do that. So.
Well, I think you're in general, like in your example, you're talking about the 70s and 80s, regional developers are going out buying properties, because obviously they're distressed properties.
Totally,
But the more important thing is, they've got cash, or they've got leverage behind them, right? They've got access to capital, because they are well looked after. That's one thing with us, when we have our 53%, instead of our 65 or 70%, when the opportunity comes, we can seize that opportunity.
Totally.
You have cash in the bank, and you can go in and refinance properties and all that stuff quite easily, because we have that.
Yeah. Even right now, we have some of the debt that we have on properties are via line of credits, all of which are undrawn, right? And so it's like, okay, again, we're prepping for the fact that when you want debt, sometimes you can't get it. And so we have those lines in place, even though they're undrawn. We see an opportunity. We have the ability to extend, $5-6 million instantly. That's where those deals come from, right? And then, to be honest and frank, you partners, right? Like our partnership group is the strength behind being able to then grow and buy new deals, right? As we see them, as we say, hey, this is where we see the market. This is something we want to capitalize on. We come to you guys and say, hey, this is what we're up to next. This is the cash that we want to raise, and then we go and place that cash.
That could be a horrible anchor.
Yes.
Right, so it's just about managing your level, so you have that flexibility to jump on an opportunity when it shows up.
Yeah, absolutely.
So right now, you've got a bit of a fixed model as to how you acquire assets. And maybe you won't maneuver from that too much, but would you be willing to get to a tighter cap rate acquisition for a better play, knowing that long term, it's better for the group?
My answer to a broker is no. My answer to the group is yes, if we see the opportunity, right? So when we look at an asset, and the reason we like showing you guys those KPIs is in part to kind of bring you along on the journey and educate you as well. So then that way, when you're talking about real estate with people, it's like, oh, I know what these words mean, right? And there's sort of a general context of what we're talking about. But when we buy an asset, I almost don't even look at the cap rate, right? We're looking at, okay, well, what's the cash flow in place? What's the nuts and bolts of the asset we're buying? What's the sticks and walls? What's the roof? And then where can we take cash flow over time, right? So we have 10-year cash flow models on every property. And we say, okay, well, this is the rent in place. This is where we think rent should be. This is where we think rent is going. And so, we might buy something at a 4 cap today, which we won't, by the way, to the brokers, because it's like, oh, wow, they're charging half of what current market rent is. And we think that those rents are even, going to go up by another 10-15% a year. Andrew highlighted the fact that our year one jump in rent growth was 12% of the current renewals, 19% over the term. That's not slowing down, right? So interest rates have really jumped up. We haven't really hit the full rent growth curve yet. So there's a lot more of that to come. So yes, we'll buy something outside of the cap rate if we see rent growth or the nuts and bolts, what are the sticks worth? If that's undervalued, then we see opportunity.
Two other things, sorry, that I have that I don't keep everybody's really thirsty. It's been a long go here, but you haven't talked about purchasing an asset based on per square foot value.
Yeah.
In today's construction market, and Darren can speak to this, and everybody sort of understands what's going on. But is that an area that you would look at for your group that? It's like, you know what, we can buy an asset and it's going to cost us $138 a square foot to buy it. And while I don't need to just single out a couple people, but versus building that asset at $300 a square foot. Do you want to speak to that a little bit?
Totally. So to me, that's what I mean by nuts and bolts or the sticks and roof, is looking at it and saying, okay, well, if it costs us if building it is going to cost us this, and we think that that's going to change to this over time, then where is that, rent growth or gap that we can take advantage of in buying it, right? So and a good example, Outpost, right? So Outpost, distressed sale, oh, thank you, appreciate it. Outpost popped up, it was poorly designed, wasn't finished. You know, we knew that industrial was one of our big investment theses, right? So it's like, we know that there's some opportunity here, we know there's rent growth, we know that there's tenants that are in the market looking, and it was $30 a foot, right? So it doesn't technically fit the mandate of Cal. There wasn't cash flow attached to that asset when we bought it, but we looked at it and said, frick, at this price, like, I don't know how you'd screw it up. So we bought it in the fund, right? We were able to take advantage of it. We also took advantage of the fact that it just got in the news that we were gonna have to move to Calgary. And so the best negotiating tactic is not caring what happens to the deal. And I think we got another $750,000 off because of that. So anyway, you have Oslo to thank for that. But yes, we're buying it based on what is there, what's the asset? Do we think that there's a gap between what an asset is worth on a per square foot basis and where it's gonna be in the future? So $30 a foot, we knew that we might spend between 70 and 85 bucks a square foot to finish it. That would put us just over 100. Well, we could build warehouses for 120, 130 bucks a foot like 3 years ago. Now it's like 200. So again, in 3 years, it went from a little over 100, 130, 140 to 200. Now we're pushing 220. So that built-in basis, protecting that basis or buying for that basis would be part of our strategy.
Last thing for me, I mean, great, this has been fantastic, and I really appreciate being offered the opportunity to be here.
Absolutely.
Scott, what did you do that Kendall cut the end of your finger off? Already.
Well, I got in an argument with my hatchet at the cabin. So, yeah, I don't recommend it.
He was supposed to get the budget down another 5%. Michael.
Sir, I've got a question about people exiting. Has there been any people wanting to sell their shares in Cal?
So units, but we have not had anyone exit or sell a unit to date, which is pretty impressive, honestly, in 5 years. We had one group request some liquidity, and not group, but individual. And we had sat down with them and said, yeah, you bet this is what it would look like. What's the situation around it? And then they said, actually, we would prefer to keep this and we're going to get liquidity from something else. So we've been asked one time, they ended up deciding to get liquidity somewhere else. We've had no units exit since we started the group in 2018.
And then another question I have is about costs for management for the limited partnership, the unit holders.
Yep.
So the team has grown now to about 12 or something like that. So
Yep.
when it was originally started,
Yep.
like the percentage of management costs, has that changed over, or is it up, like it's pretty well stable, the percentage?
No, yeah, it's a good question. So no, so the team is paid for by Summis. Summis is the designated manager for Cal, but it's also the manager for Frontier, right? It's a manager for North Point. We have the tenants themselves actually hire us to do tenant improvements for them, et cetera. So there are other revenue streams that pay for and help build out the platform of Summis, which in turn benefits Cal. But the fees that were negotiated at the beginning of Cal have not changed. So those fees stay intact. As we have more value to add inside a project, so let's say Outpost, for example. Well, managing that development project, the pro forma, construction financing, the leasing attached to it, that's beyond the scope of normal asset management, right? And so what we do is we build in a development management fee into the pro forma, right? So we say, okay, well, if we're gonna buy it, we're gonna do all this work. What's the cost to do that? Let's make sure that the return metrics still make sense for the fund. And then some of us would collect that development management fee, right? So we would build in some of those project-based expenses into a project. If the project makes sense, we do it. If it doesn't, we don't do it. So me personally, I'm choosing to reinvest, my growth or the extra money for myself into building out the team, right? I think that the most important, my biggest project now, beyond the individual projects we have, is the team we have, right? Because how does that team continue to allow us to grow? How does that team give us the advantage? How does that team ensure that there's continuity and support for all of you if something were to happen to me? So no, the costs are not increasing. As the fund grows, there's more dollars. Summis bears those costs and then can capitalize on those costs via different projects as the platform grows.
It's maybe a big question, but what's driving the growth of leverage? Or what will drive the growth for the next 5 or 10 years?
Yeah.
So in the past or historically, it's really been public sector and then ag and then the support off of ag, right? So those have been the two drivers. Lethbridge has been steady Eddie for a ridiculous amount of time. It's like, if you go back and look at a 50-year chart, it's like, there's no exciting bumps, but there's also no big dips, right? It's like 1.5% for 50 years. It's ridiculous. What I think is going to drive it going forward will be sort of the focus on food and then value add manufacturing off of food. I think we're seeing a much bigger push in that. Some of the users that we're talking to about industrial leases, expansion, a lot of them are in that area, that sector, that field. So I think that will be big. And then affordability, right? You know, you look at, okay, well, a condo is $1 million in Vancouver. And this, I think, is what's driving Calgary right now, because it's like, okay, you know what, I just can't afford to live in this city. And so then what does it look like here? But I think we'll get some of the overfill effect of then, okay, well, now I can't afford to live in Calgary. So then where's Lethbridge, right? Or I live outside of Vancouver. I don't necessarily want to go into Calgary. Okay, this is what Lethbridge has to offer. So I would say diversified economy and the quality of life and then affordability attached to it will be a big driver for us moving forward. Yeah, as a whole, the net migration, I don't know if you guys have looked them up, but the net migration numbers into Alberta are wild. Like we've got net migration of 150,000 people in 2 quarters in 2023 into Alberta, right? That is huge population growth. And you're seeing that because it's now no longer affordable to live in, you know, BC and Ontario. And so that will be something that is a little counter-cyclical as we go through this next cycle. There's going to be pressure on interest rates, pressure on the economy in general. Alberta is a little counter-cyclical of as there's more pressure elsewhere, then people are kind of driving here for food, for energy, for the fact that we have a bit of an upswing, and then also for affordability and immigration. So I think that will help balance out some of the bumps in the next 2 years.
I think it's fair to say that in Lethbridge, we've gotten some buys because we were out of the mainstream markets.
Yeah.
And it lost the attention of the big players.
Yeah.
They saw Lethbridge as a outpost kind of market, and it's our hometown. So we kind of looked at it and said, no, this is going to work. Whereas the big players that might have been our competitors just didn't show up.
Yeah. And they're still not here, right? And then the market gets tough and they kind of retreat back to what they know in their home market. So I would say, you know, there are other players in Lethbridge. We're not the only player, but I think we have a pretty commanding presence and we've got great relationships here. And that puts us in a good position to take advantage of the growth that we'll see in the next 2-3 years.
And how many players in Lethbridge, different groups come to mind? Like, are you talking 2, 3, 10, 20?
No, that's a good question. I would say that there are, in terms of the stabilized cash flowing assets, I would say that there's probably 3 organized groups, one of which is floating rate debt and negative DSCR. So we'll see how long they last. The other 2 of which are good, right? They're good at what they do. They both have, I would say, niches and focus on sort of specific assets. Unlike us, we've got a little bit more of a diversified pool. And then there's a few more developers, but only one of which I would say has any kind of platform or team behind them. They're generally very principle driven, which is common in the real estate business, right? You have 1 or 2 talented people. And so then it's a principle driven organization and they have a run and then they're done. Or you have these crazy big institutions, which are often pension funds, publicly traded entities, and there really is none of those active here. There's one that owns property here, but they're really not active. So we have competitors. I don't think any of them are that competitive with us. So. Which is a nice position to be in. I won't stay that way forever. Any other questions? I love the extra questions. Usually you guys are quite quiet, so I'm excited to hear some of the dialogue and feedback. I appreciate that. And I appreciate you guys being partners in our group. The trust that you have given us in order to place your money and invest it and be stewards of it is something we don't take lightly. That's something that's a pretty big responsibility and something that we talk about as a team frequently because it is a big responsibility that we're happy to fulfill.
One last compliment to the group. We always said we didn't want any jerks invested because we didn't want the hassle of having a jerk invested.
No assholes allowed.
You guys are awesome.
Thank you. Yes, no, absolutely. Yeah, we have a wonderful group. And I think even that is a competitive advantage, right? I would say some of those other
other groups, or even just looking at the real estate market in general, there's a lot of assholes. And so when we talk with our tenants, you know, honestly, that's something that they comment on is like, hey, we like working with you guys.
You didn't define that term.
What's that? That one's self-explanatory. But there really is. And I think, you know, focusing on relationships is big. The real estate business is a relationship business. And so that's something that we push on, we lean on. And I think it's important in our growth strategy moving forward. So anything else? Okay, we're done. That's a wrap. There's some drinks. We'll make sure that we have someone come interact. We'll get some drinks next time, especially if you're going to have so many questions. So we'll be around. We have the room all night, as they say. But if you have anything that you didn't get to ask, please let us know.